Brookfield is a huge name in Canada, and Brookfield Corporation may just be one of our favorite asset managers. Fasten your seatbelts, folks. This is going to be a good one. Brookfield Corporation is an investment firm or asset manager that specializes in building long-term wealth for their investors. They basically invest in other companies or assets that align with their overall goals and with shareholder expectations. Brookfield has been returning an average return of 15% annualized over the last 30 years. However, this version of Brookfield only started trading on December 22nd, 2022. That does not add up to 30 years. Let me explain. A few years ago, Brookfield Asset Management, with the ticker of BAM.A, underwent a pretty significant strategic restructuring. They essentially spun off two new companies, the new Brookfield Asset Management, or BAM, without the A, and Brookfield Corporation, or BN. The spinoff was designed to unlock shareholder value by separating the asset management business from Brookfield's operating businesses. As a result, BAM now focuses on managing a broad range of alternative assets, generating stable fee-based revenue. On the other hand, BN holds the corporation's substantial investments in real estate, infrastructure, renewable power, and other private equity assets. That probably sounds a little confusing. So if we were to boil that all down, BAM is basically your more income-focused stock, while BN is more of a total return growth stock. Speaking of growth, a sub to the channel would be a great investment in future content. For this deep dive, I pulled the data from their August 8th Q2 earnings. Overall, the report was almost a mixed bag. They did fantastic on their earnings as they surpassed expectations by a whopping 77.14%. However, they did miss on revenue by 3.6%. I still see this as a win. But with earnings that huge, we could be in for some skewed data. One thing I did find interesting in their Q2 materials is all about share buybacks. Since the beginning of the year, they have spent close to $800 million on buying back shares. It is estimated that they reduced the number of outstanding shares by about 20 million, which was just a little over 1% of their total shares. Of course, that should have a positive impact on the price of their share. I think it is time we get into the fundamentals. As usual, to do that, we will need to call on the calculating commander, the Duke of Division, the one and only Mr. Math. Let's kick this off with a little surface data, shall we? Their current value at the time of recording is $60.91, and they have a market cap of $95.61 billion. Their beta comes in at 1.74. That, of course, means they're 1.74 times more volatile than the market average. Their earnings per share, they're coming in at 0.78. That price to earnings ratio, oh boy, it's big, 79.10. The average amongst their peers is actually 14.2. So looking at a few of those pairs, 1X has a PE ratio of 6.2, IGM Financial 10.3, and BAM, Brookfield Asset Management 37.1. Their price to book ratio, that comes in at 1.70. The average amongst those exact same pairs, 2.0. Their return on equity, that comes in at 2.31%, and they have a return on assets of 2.10%. I would really love to see both the ROE and the ROA to come up a little, but nonetheless, the surface data does look okay in my opinion. Okay, let's peel back another layer and take a look at their cash flow as well as their fair value. They had revenue of $97.66 billion, and their earnings come in at $908.00 million. I don't have any projected earnings growth this time around, but I will throw in the revenue growth rate for that quarter was 10.1%, so that's not too shabby. They do have a profit margin of 0.9%. Their free cash flow, it is in the negative, negative $2.32 billion. Operating cash flow of $951.47 million. I suspect we are going to see the effects of those crazy high earnings turn up here when we look at their fair value. To put things in perspective though, their earnings in the last year grew by 505.3%. This is going to affect the cash flow model, so you will need to take it with a grain of salt. Their current value, once again, is $60.91. Using a discounted cash flow model, oh boy, we get a fair value of $9.91. I did mention to take this with a grain of salt because this suggests that they are overvalued by 512.2%. Obviously, this calculation is skewed, and you really can't put a lot of faith into those numbers. I do believe they may be overvalued, but nowhere remotely close to that. The 1-year projection, I also believe that this is a little skewed. It's coming in at $55.83, so that's a drop of 8%. Once again, I do think that this projection will change big time when we get into that Q3 report in 3 months. One other thing you do have to take into consideration is their $4.5 billion acquisition of a 51% stake in American Equity Investment Life Holding Company. And that purchase, that's still affecting their fundamentals. In fact, that's where some of that money is going when you look at that negative cash flow. This is a great move for Brookfield. And as early as their next quarterly, we should see this purchase impacting their fundamentals considerably less. Let's dive deeper and take a look at their dividends and returns. I did point out that this, of course, is the growth stock, so they don't have a huge dividend. That yield comes in at 0.725%. That's a quarterly dividend of 8 cents USD per share. Payout ratio on that, 52.63%. Switching to returns, their 3-year return on investment comes in at 43.59%. Factor in the dividends, we do get a total return of 44.81%. I do want to point out on that 3-year, it's actually closer to a 1-year, 8-month, as once again, they did start trading under this ticker back in December 22nd of 2022. On their 1-year, that return on investment comes in at 39.54%. Total return, 40.25%. On the year to date, the return on investment comes in at 15.80%. Factor in the dividends, we get a total return of 16.25%. The return data looks really good, and it sure does make me think we're going up opposed to that negative analyst target. Okay, let's take that final dive and go right down into that debt situation. They have a total debt of $242.52 billion. Total equity, $167.56 billion. So that's a debt to equity ratio of 144.7%. At that time, when the old BAM spun off into the new BAM and Brookfield Corporation, they did take all of the old BAM's debt, and their debt to equity ratio was actually sitting at 153%. Since then, they have knocked that down a wee bit, so they are moving it in the right direction. Now, when it comes to cash and cash equivalents, they are sitting on $11.25 billion. Looking at their short term, they have assets of $56.18 billion and liabilities of $57.79 billion. On the long term, they have assets of $441.13 billion and liabilities of $271.96 billion. It will come as no surprise that there's no share dilution, considering they did some stock buybacks. They are working to reduce the debt, but nonetheless, it is not an ideal situation. The debt is not covered by their operating cash flow, and the servicing of the debt is also not covered by their EBIT, earnings before interest and taxes. However, between rate cuts and the one-off of that insurance company stake, this should improve big time. Okay, I think we have enough data to make a final verdict. I like both Brookfield Asset Management and Brookfield Corporation. In fact, BN has been winning the total return title between the two. That sure does make me wonder if I should hold both in the 0 to 100K challenge. Looking specifically at BN, they do have a lot of debt for sure, and the fundamentals do show some strain from that recent acquisition. However, they are still lowering their debt to equity, and that shows just how well this company is managed. I think it is a great choice for the long-term total return investor. They are designed for growth, and they will more than likely never disappoint when it comes to that. The passive income-focused investor will not like this one, as they really don't have it in the dividend department. There is BAM, but even their dividends may be too low as well for the hardcore passive income folk. Overall, I do think this is a great total return stock, and I can't wait to peek in on their fundamentals next time, as I suspect they will make me love this stock even more. If you are interested in BN, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on Scotiabank. Thank you for watching, and I will see you in the next video.